Something has happened in Washington, and this is not just another debate over debt or politics. It's not a quarrel in Congress or another spike in inflation. It's something far more dangerous. Major players on Wall Street, the very ones who for decades were considered the backbone of American financial stability, have begun to pull out, quietly but definitively. They no longer believe in U.S. government debt. Citadel Securities is not a small shop with a risky strategy. It is one of the largest liquidity providers in the world. Their decision to unload a significant portion of long-term U.S. bonds says only one thing: fear is emerging within the system itself, a fear that cannot be dismissed as political rhetoric or ordinary economic cycles. This is now structural distrust in the very foundation of the dollar as a global currency. Think about it. If giants like J.P. Morgan, Bank of America, and Wells Fargo are consistently reducing their exposure to U.S. government bonds, who is left in the game? Who is now willing to sponsor America's deficits? China? Japan? No. They are also heading for the exit. In just the first quarter of 2025, according to official U.S. Treasury data, Japan reduced its holdings of Treasuries by $21.4 billion, down to the lowest level in a decade. And China, to $767 billion. That's the lowest figure since 2009. And this is not just a portfolio reshuffle. This is a systemic retreat from the dollar as a global anchor. A leak from the State Administration of Foreign Exchange, SAFE, in China confirms Beijing is reorienting its reserves toward gold and other strategic assets. This is no longer an investment. This is a hedge against system collapse. Why is this mass exodus happening now? The answer is simple. Inflation in the U.S. is not going away. The core consumer price index for March rose by 0.6%, giving an annual figure of 4.2%, twice the Federal Reserve's target level. At the same time, the yield on 10-year Treasuries has already surpassed 4.95%. Nominally attractive, but real yield is rapidly vanishing. You're earning 5%, but inflation is 4.2%. And on top of that, you're holding an asset that depends on the politics of the White House and the debt ceiling. Now tell me, would you invest your retirement savings in such an instrument? The Federal Reserve is in despair. The meeting minutes from April 4th openly acknowledged for the first time, if demand for Treasuries continues to fall, they will have to relaunch quantitative easing, printing money to buy their own debt. But this is no longer 2020. Inflation is real now, and flooding it with liquidity is like trying to extinguish a fire with gasoline. Many experts compare this to the activation of a self-destruction mechanism. Renowned economist Zoltan Pozsar stated bluntly, "Under such conditions, quantitative easing is not a rescue, it is a capitulation." It is no surprise that in April, gold rose by 6%, reaching $2,380 per ounce. The dollar index, DXY, dropped below 101. Central banks around the world are restructuring their reserves. According to data from the World Gold Council, in the first quarter of 2025, they acquired 290 metric tons of gold, 45% more than the same period a year earlier. Leading the trend, China, Singapore, and Poland. What is this, if not a global referendum against the dollar? Now imagine what is happening to American banks. They are forced to accumulate treasuries to meet regulatory requirements. But when interest rates rise, the price of these bonds falls. A paradox? No, a trap. This exact scenario destroyed Silicon Valley Bank in 2023, unrealized losses of $15 billion. Now imagine this risk scaled to the entire banking system. Ask yourself, if domestic banks can no longer buy and foreign holders are exiting, then who is financing the United States? The answer may shock you. Future buyers are not nations, not banks, and not even people. Major hedge funds and algorithmic traders, such as BlackRock and Two Sigma, have already begun testing tokenized bonds, programmable money, smart contracts, transactions without the participation of the Federal Reserve or the Treasury Department. Welcome to a new era, where trust in institutions is replaced by a line of code. And so, you stand at the threshold of an entirely new financial system, where artificial intelligence determines the real-time value of U.S. debt. No diplomacy, no alliances, no compromise, just cold calculation. And what if the dollar begins to be perceived as the currency of an emerging market? Former BIS chief economist William White says, gold is once again becoming an asset immune to political risk. Its rise is not speculation, it is structure. And in April, the founder of Bridgewater, Ray Dalio, stated that the United States is in the fifth stage of the debt cycle. This is the stage that precedes internal restructuring. The national debt already exceeds 124% of GDP. In 2025, just servicing the debt will cost $1.12 trillion, more than defense spending. According to projections from the Congressional Budget Office, CBO, by 2026, 18% of all tax revenues will go solely toward interest payments. This situation resembles Latin America more than a global superpower. And this is where the core issue begins. If neither external nor internal players are saving the system, who is left? Maybe the United States will actually attempt to inflate away the debt, that is, devalue it through rising prices. But if that's the case, brace yourselves, holders of bonds, pension funds, and dollar-denominated savings. You are the bag holders in this game. And if, at the next Treasury auction, the U.S. government fails to sell its debt, it won't be a technical glitch. It will be a collapse of trust, a moment after which there is no return to the old system. Think about this. China now holds only 3.1% of U.S. debt. In 2011, it was 7.5%. The share is cut in half. World powers no longer want to finance America's lifestyle on credit. And if this is not the end of an era, then it is, at the very least, its final act. Share your thoughts. Do you believe the dollar will remain the global reserve currency? Or are we heading toward a new architecture of the global economy without the United States at its center?